Good afternoon, everyone. Today we are debating the statement, buying residential property through a self-managed super fund is financially irresponsible. As the Affirmative team, we strongly agree with this statement and believe that using an SMSF to buy residential property exposes investors to excessive risk, poor diversification, and long-term financial strain. It undermines the very purpose of superannuation, which is to provide a stable and secure retirement income. First, I'll reveal that buying property in an SMSF leads to excessive concentration risk and lack of diversification, which leaves investors exposed to property market downturns, whilst my teammate Daksh will explain why liquidity and borrowing restrictions make residential property unsuitable for superannuation. Many Australians are drawn to the idea of using their super to purchase property because it feels tangible and safe. However, as O'Reilly points out, this emotional bias blinds them to the fundamental issue. It locks most of their retirement savings into a single, undiversified asset. O'Reilly highlights that when a self-managed super fund purchases residential property, it often consumes a majority of the fund's assets and leaves almost no diversification into shares, cash, or bonds. This concentration risk turns a retirement savings vehicle into a property gamble rather than a balanced super fund. In support of this, ASIC argues that SMSFs with balances below $500,000 have lower returns after expenses and tax than funds regulated by APRA. This clearly demonstrates how smaller SMSFs, which are most likely to invest in property, underperform larger diversified funds as a result of high costs and poor risk spreading. This contrasts with the APRA-regulated funds, which hold diversified portfolios of equities, bonds, infrastructure, and cash to manage volatility. In addition to this, AFR journalist Michael Reid reported that the property market downturn is poised to wipe billions off the value of self-managed super funds. He quoted CoreLogic data revealing that Australian housing prices had fallen by 8.4% since their peak in May 2022, which is the largest fall on record. To put this into perspective, during the 2022 to 23 property correction, a fall of 8.4% on a property worth approximately $500,000 is the equivalent of a $42,000 loss, with no liquidity buffer to offset it. This clearly demonstrates how property-heavy SMSFs severely underperform diversified funds due to the lack of exposure to other sectors like infrastructure and equities. As O'Reilly concludes, putting your super into one house isn't a strategy, it's speculation. If the suburb underperforms or interest rates rise, retirees bear the full brunt with no safety net. Diversification is not optional. It is the foundation of careful investing. SMSFs that ignore this for the emotional comfort of property ownership are financially irresponsible. Thank you.
Thank you, Bridget, for your perspective. My name is Akhand, and my partner, Adonis, and I will be arguing the negative. That buying a property through a SMSF provides members with a diversifying opportunity, yet stable returns. This provides a perfectly risk-balanced retirement portfolio, making it a reasonable investment. Bridget raised some real concerns about risk and diversification, but her arguments overlook the systems already in place. The ATO requires every SMSF to have a written investment strategy that considers diversification and liquidity under the Superannuation Industry Regulations Act, so buying property without cash buffers or other assets breaches compliance. Secondly, Bridget cited ASIC's concern about smaller SMSFs underperforming. However, that is a very niche category. The ATO's June 2025 statistical report iterates the average SMSF balance is $1.6 million. That means all of these funds can easily hold a property alongside other financial instruments to offset their risks. ASIC's concern of SMSFs with a balance below $500,000 can be narrowed down to poor financial advice and underfunded investments, leading to underperformance of the portfolio rather than the investment property itself. Finally, calling the investment a speculation and the 8.4% property price fall needs context, as it ignores decades of performance data. According to the Australian Bureau of Statistics Residential Report, the Australian dwelling values have grown by about 67% over the long run. This brings me to my argument for the negative side. Firstly, strategic planning and management allows SMSFs to access higher asset values with instruments like limited resource borrowing arrangements. This enables trustees to buy a quality property with high growth and rental yields that might otherwise be out of reach. Tim Keith highlights in his article the $160 billion problem with Australian SMSFs and how to fix it, that big banks are paying much less on term deposits. It may pay SMSFs to instead allocate funding to a form of fixed income linked to property. Secondly, Residential property aligns with a superannuation's time horizon as a proven stable long-term performer. Australia's housing market has shown significant growth over the last 2 decades, but as Scott Kuru stipulates in his article, COVID Property Boom Impact Still in Play, Australian home values have risen by a cumulative 38.4%, which adds $227,000 to the average median value of the Australian homes. The ABS and CoreLogic 2025 data further show that the national residential property values have increased by 67% over the last 10 years, despite the short-term corrections in 2022 to 2023. This was due to the housing crisis and rising interests. However, Kuru goes on to mention, while nowhere near as volatile as stock market's rollercoaster ride, Tim Lawless points out that Australia's residential properties growth path has been far more straightforward. This demonstrates the property remains a consistent inflation-resilient performer while being less volatile than a diversified portfolio. Finally, a residential property provides both capital and rental growth income. Rental typically yields 3 to 5%, providing a SMSF with steady cash flow to meet pension withdrawals as well as mitigate property risks such as loan repayments. If the property is paid off, they can also choose to reinvest their cash flow into other financial assets. When combined with years of growth and compounding, this property produces substantial long-term returns comparable to or even exceeding those of a diversified portfolio. Therefore, buying a residential property through SMSF is financially responsible as it provides stable income, capital growth, and control, allowing trustees to both plan confidently for retirement, unlike diversified portfolios, which are very fluctuate and heavily dependent on government policies, economic cycles, and corporate performances. Thank you.
Thanks, Akhand. I hear your point about strategic planning and making property inside an SMSF responsible, but I don't think that really holds up in the current real world. Firstly, yes, regulations require diversification, but the actual reality is very different. When one property eats up, let's say 70 to 90% of a fund, the normal rule on paper doesn't really exist. Second, you mentioned the average SMSF being around 1.6 billion, but averages can be misleading. And in many circumstances, they're inflated by a handful of very large funds on the upper scale. The median balance is much closer to a $400,000 to $500,000, which is exactly the range that ASIC warns for struggles with cost and underperformance. So for most regular Australians every day, property dominates their super rather than, I guess, diversifying it. And lastly, long-term growth in housing, I guess, sounds comforting, but retirees don't spend averages. They need liquidity and cash flow in the current state of the world. And as I'll mention soon, O'Reilly himself states, you can't sell a bathroom to pay your pension. And in many cases, rental yields of 3 to 5% get chewed up by loan repayments, maintenance, and compliance costs. So kind of, I guess, technically, while strategic planning sounds like it fixes the risks, in reality, it doesn't really remove the fundamental problems of property in an SMSF, still being illiquid and expensive. Now, flowing back into our affirmative side, I will build on Bridget's points upon diversification by focusing on liquidity and borrowing restrictions that make residential property unsuitable for superannuation. Now, superannuation mainly exists to fund retirement income. This requires assets that can generate reliable cash flow and be adjusted gradually as members age. However, residential property is fundamentally illiquid. Unlike shares or bonds, you cannot sell part of a house to meet pension withdrawals. As James O'Reilly emphasizes in the AFR article, you can't sell a bathroom to pay your pension. This illustrates the mismatch between the nature of the asset and the purpose of superannuation. If retirees need to withdraw funds during a property downturn, they may be forced to sell the entire property at a significant loss. As shown in the previous slide, CoreLogic data show that from May 2022 to 2023, house prices fell by 8.4%, the sharpest decline on record, wiping billions from SMSF balances. Furthermore, this problem worsened by the fact that most SMSFs buying property relied on limited resource borrowing arrangements. O'Reilly describes this as an expensive way to bet the house. These loans are complex and costly to establish, requiring a separate bare trust structure, legal documentation, and ongoing compliance. They also magnify risk. If property value falls, the losses are amplified by leverage. Unlike diversified super funds, which can rebalance or adjust asset allocations, SMSFs with a geared property are locked into rigid repayment schedules. As ASIC warns, this can drain retirement savings instead of growing them, especially when rental income fails to cover interest, rates, and maintenance. On top of liquidity and leverage risk, SMSF property purchases involve significant transaction and compliance costs. These include stamp duty, ongoing maintenance, property management, annual independent valuations, and strict restrictions on renting to related parties. ASIC has repeatedly cautioned that SMSF balances with below $500,000 are rarely cost-effective after these expenses. Yet, according to the SMSF Association, the typical residential property acquired through an SMSF costs between $700,000 and $800,000. This often forced trustees to commit nearly their entire superannuation balance into a single asset, leaving little room for diversification or liquidity reserves. When taken together, these issues make residential property fundamentally incompatible with the objectives of superannuation. A well-structured super fund should provide diversified, liquid, and income-generating assets that can support retirement with stability and flexibility. By contrast, a residential property inside an SMSF delivers the opposite: illiquidity, high cost, and speculative exposure to one market cycle. That is why O'Reilly concludes with, putting a super into one house isn't a strategy, it's speculation. And speculation with retirement savings is not just unwise, it is financially irresponsible.
To start, I would like to thank Daksh for his additional input for the positive side. While it is true that you cannot sell properties per part as you can with other asset classes, such as stocks or bonds, nor are they as liquid as them, they provide value in other ways, such as being able to generate steady cash flow income through rents. I would also disagree with the notion that LRBAs are a negative aspect of investing in property, as they give the investors of SMSFs additional strategic options through the form of leverage in their proverbial toolkit. Which brings me to my next point. What really are LRBAs? Essentially, they are a form of limited leverage you can use to buy property, meaning lenders can only claim the property that you borrowed for, an option which is simply unavailable to other asset classes. I also disagree with the notion that, I quote, they also magnify property risk. If property values fall, the losses are amplified by leverage, end quote. First of all, what type of property are we talking about? Commercials or residentials? And secondly, residential properties have a broad range of entry points, which makes me wonder how they came up with this and if they have considered specifically low-cost residential properties or other mixes and types of residential property. As University of Adelaide's International Center for Financial Services discovered, across 3 financial years, 2017 to 2019, and examining 7 asset classes, cash and term deposits, listed Australian equities, listed international equities, listed trusts, unlisted trusts, limited recourse borrowing arrangements, LRBAs, and other assets, the research finds the least diversified SMSFs, those holding a single asset class, recorded the lowest performance. Therefore, thinking about residential properties as a diversifying tool rather than the main investment vehicle is, in my opinion, the best way to view residential properties. As UA finds, each increase of additional asset class, up to 4, appears to be associated with an improvement in the median rate of return, or ROR, of between 1% and 3%. In fact, they found out that, I quote, the report says the impact on fund performance of LRBAs is more difficult to disentangle, as the data does not differentiate between loan costs and the effect of leverage and the performance of underlying assets. However, despite these limitations, the evidence shows that SMSF performance improves for funds in higher LRBA percentiles. End quote. Therefore, I believe residential properties do have a place for that 3rd or 4th assets in SMSFs. Finally, I'd like to leave with this. Why specifically residentials then? I think we can all agree that property is a big investment. With Division 296 coming into play, it's now more important than ever to optimize the splits of your SMSF. Generally, commercial properties are more volatile than residential properties. According to Acumentis, I quote, SMSFs heavily invested in direct property, particularly commercial properties, often face sharp valuation gains. At the end of 2022, property made up about 10.3% of SMSF assets. Therefore, they contain more risk, triggering Division 296. If we want to have that 4th asset and also decrease our volatility, I believe that the value proposition provided by residential properties is only getting stronger by the day. Thank you.
Thank you, Akhand. You said that property in a self-managed super fund is responsible because limited recourse borrowing arrangements offer protection and that residential property can serve as a useful 3rd or 4th asset to diversify. But the study you cited actually supports our side. It found that self-managed super funds holding a single asset class recorded the lowest performance, and that diversification across multiple assets improved returns, which is exactly why concentrating in property is financially irresponsible. While you mentioned a limited recourse borrowing arrangement as a benefit, the reality is that leverage magnifies gains and losses. So when property prices fall, like I mentioned earlier, self-managed super funds using debt are hit twice as hard. The ATO and ASIC can regulate compliance, but they can't regulate performance or stop market downturns. Yes, property can grow over time, but not without significant risks. So when retirees put the majority of their super into a sole property, they gamble their future on one market. In conclusion, our team stands firm on the statement that buying residential property through a self-managed super fund is financially irresponsible. No level of regulation, tax incentive, or optimism replaces diversification. Thank you to the negative team for your arguments, and thank you to everyone else for listening.